This episode is supported by AnalystKit.com. Thousands of tried-and-true calculations mixed with AI to find you the best stocks in a single click.
Right now, literally trillions of dollars of global retirement money are being managed by this, elegant Nobel Prize-winning mathematical machine.
Yeah, it dictates the wealth of nations, really.
Exactly, the future of your savings, the whole structure of global markets. But, and this is the crazy part, at the very center of that machine is a massive, fragile flaw.
It is entirely based on guessing.
Which is wild.
It really is. It's the great paradox of modern finance. I mean, we have wrapped the fundamental chaos of the future in these layers of calculus and covariance matrices to make it look like physics.
Right, but unlike physics, the gravity in the financial world can just suddenly change direction without any warning.
Exactly. It's a completely different environment.
Okay, let's unpack this. Welcome to today's deep dive. We are pulling our insights today from a really brilliant video lecture titled Demystifying Your Portfolio Final.mp4.
It's a fantastic resource.
It really is. And our mission for you today, our resident learner, who, already knows the basic difference between a stock and a bond, but wants to know how the gears actually turn, is to strip away all the jargon.
Right. Get past the noise.
Exactly. We want to look at the exact mechanics of how investment portfolios are truly built. We're going past the surface level advice and getting into the math, the psychology, and, well, the absolute limits of human forecasting.
And what's great about the source material is it levels the playing field completely. I mean, whether you manage a $10 billion endowment or just a personal retirement account, every single investor stands at the exact same crossroads when they begin.
It's the engine of investing.
Yes. You face this mechanical trade-off.
So the fundamental choice, you want a small, guaranteed return, you play it safe. But if you want a massive potential gain, you have to embrace uncertainty.
Right.
But our source makes a hard pivot on how we actually define that uncertainty. Because most people hear the word risk and they picture, probability of ruin.
Yeah, going to a casino, putting it all on black, and just losing everything.
Exactly.
Which is, and this is key, an emotional definition, not a mathematical one.
Right.
In portfolio construction, risk is purely defined as variance. It is standard deviation. It's basically the measure of dispersion around an expected outcome.
So like how wild the ups and downs can be.
Exactly. When you buy a short-term government bond, the dispersion is essentially zero. The outcome is locked. But when you move out on the risk curve to equities, you aren't just taking on the chance of loss. You are actively buying sheer volatility.
You're paying to ride the roller coaster.
That's a perfect way to put it.
And that variance is the literal price of admission. Because an asset has wild swings, like up 30% one year, down 20% the next. The market mathematically forces that asset to offer a higher long-term expected return.
It has to.
Right, because if it didn't offer a higher potential reward, no rational actor would ever buy it. The price would plummet until the expected return finally increased.
And that mechanism is the risk premium. You are being compensated specifically for enduring the discomfort of not knowing what your portfolio will be worth on, say, any given Tuesday.
Yeah, that uncertainty.
Right. The common mistake is thinking risk and return are independent variables that you can negotiate separately. They aren't. They are the exact same variable viewed through different lenses.
So the ironclad rule is there is no free lunch. To get the premium, you have to ride the roller coaster.
You absolutely do.
But, if variance is the enemy of a smooth ride, we don't just have to sit there and take the full force of it, right? I mean, we aren't forced into a binary choice between a zero-growth bond and a terrifyingly volatile tech stock.
No, not at all. You can blend them.
Right. You have a middle ground. You could do a 50-50 balanced portfolio, half safe assets, half risky ones, and the risk and return land right in the middle.
And you are in complete control of that mix. By changing the percentages or the weights, you tailor the portfolio to your exact comfort level.
So if you hate losing money, you lean conservative.
Exactly.
Yeah.
And if you're okay with volatility for higher growth, you lean aggressive.
But the source makes a really critical distinction here. True diversification isn't just buying 50 different things. Like, buying 50 different tech stocks doesn't protect you if the entire tech sector implodes.
No, it doesn't. The mathematical imperative here is finding assets that exhibit different behaviors.
Yeah.
You are looking for correlation, or really a lack of correlation.
You want things that do not move in lockstep with each other.
Precisely.
I like to think of it like acoustic phase cancellation and noise canceling headphones.
Oh, that's a great analogy.
Right, because the stock market emits this jagged, loud sound wave of volatility. If you want to quiet the noise, you don't add another sound wave doing the exact same thing. You find an asset, maybe high-quality bonds, that emits a completely different sound wave.
Right, they behave differently.
Exactly. When equities zig, the bonds might zag, or at least just hold flat. They cancel each other's extremes out, leaving you with a much smoother, quieter ride.
If we connect this to the bigger picture, that phase cancellation is the absolute core of modern portfolio theory, or MPT. It's a Nobel Prize-winning idea.
It's basically the holy grail of investing.
It is. It's a framework that proves mathematically that by combining assets with different behaviors, you can actually create a portfolio that has a higher expected return than its individual components for a given level of risk.
Wait, higher return for the same risk? That sounds suspiciously like the free lunch we were just told doesn't exist.
Yeah, it's widely considered the only free lunch in finance. The breakthrough of MPT was showing that risk isn't just about the volatility of the individual assets, it's about how they interact in the overall matrix of the portfolio.
So a highly volatile asset might actually lower your total portfolio risk if it moves inversely to everything else you own.
Exactly. It's all about the combination.
Yeah.
MPT isn't about finding the single best investment in the world. It's about finding the single best combination for your specific risk tolerance.
Let's walk through the actual engine of MPT, because the source lays out a very logical three-step optimization process. Step 1, you have to establish the estimates.
Right. You project the expected returns, the variance, and how every single asset behaves relative to every other asset.
And then step 2 is mapping the universe of possibilities.
Yeah. You run a mathematical algorithm to plot every single conceivable combination of those assets, adjusting the portfolio weights by fractions of a percent.
Which plots thousands of potential portfolios on a graph, right? With risk on the horizontal axis and return on the vertical.
Exactly. And this naturally forms a boundary on the graph. The top edge of that curve, where the return is maximized for every single unit of risk, is the optimal zone.
The efficient frontier.
Yes, the efficient frontier. Any portfolio sitting exactly on that line is mathematically optimal. It means you cannot squeeze one more drop of expected return out of that specific combination without taking on more variance.
And step 3 is just picking your spot on the line. The math doesn't tell you which point to pick.
No, that's entirely up to you.
Right. If you hate losing money, you pick the low variance spot on the left side of the curve. If you want maximum growth and don't care about the bumps, you ride the curve up to the right. The math just ensures that wherever you sit, you are getting the absolute best deal for that level of anxiety.
It is a stunningly elegant framework.
Yeah.
But traditional applications of MPT usually implement this by mixing massive generic asset classes.
Like putting all U.S. stocks in one bucket, all bonds in another.
Right.
Which seems incredibly clumsy. I mean, if MPT is so precise, why are we treating all equities as if they behave the exact same way? Aren't we leaving a massive amount of return on the table by lumping like a highly profitable tech giant into the same bucket as a struggling retail chain?
We absolutely are. The broad market index simply weights companies by how big they are, completely ignoring their underlying characteristics. And this realization led to an evolution in how we build portfolios.
So here's where it gets really interesting, because the source introduces this buzzword, smart beta.
Yes, smart beta.
And we need to clarify immediately. Smart beta does not throw out modern portfolio theory. It builds directly on top of it.
Exactly. It uses the exact same risk-return optimization framework, but applies it microscopically. It's a more targeted, systematic, data-driven way to put diversification into practice.
Right. It systematically tilts the portfolio towards specific characteristics within the stock market that historically beat the broad index. The source specifically highlights two factors, value and momentum.
Value is the quintessential factor. A smart beta value strategy systematically scans the market and tilts your portfolio towards stocks that are priced cheaply relative to their fundamental accounting metrics.
Things like their book value or their earnings.
Right, undervalued stocks.
But let's dig into the mechanics of why buying cheap stocks mathematically yields a premium over time. It isn't magic. It comes down to either behavioral psychology or hidden risk.
Yeah, let's start with the behavioral side.
Behaviorally, human investors panic. We overreact to bad news. We dump a stock because of a missed earnings report, driving the price irrationally low.
Right, people get emotional.
Exactly. And the value factor operates mechanically, buying that human fear, just waiting for the inevitable reversion to the mean.
But then you have the competing explanation, the efficient market view, which is that value stocks are cheap for a legitimate reason.
Like they're just distressed companies.
Exactly. They carry higher underlying economic risk, perhaps massive debt or extreme sensitivity to economic cycles. Therefore, the market demands a higher expected return as compensation for holding them.
Either way, whether it is a behavioral anomaly or a hidden risk premium, the factor persists in the data. You are engineering a specific return. And then you have the second factor, momentum.
Momentum. Conceptually, it is the polar opposite of value.
Right. It systematically buys stocks that have been going up recently and ignores what's been going down. It defies the fundamental advice of buy low, sell high. It basically operates on buy high, sell higher.
And the mechanism driving momentum is largely herding behavior and institutional mechanics. Humans love a winner. When a stock starts moving rapidly, retail investors pile in out of FOMO.
Fear of missing out.
Exactly.
And it isn't just retail investors, right? Massive institutional funds take weeks or even months to build or exit a position. They can't just buy $1 billion of stock in a single day without completely breaking the market.
No, they have to do it slowly.
That slow, methodical capital deployment creates a sustained tailwind of buying pressure. The momentum factor just mathematically surfs that wave.
So instead of just buying a generic stock index, a smart beta strategy takes these empirically proven value and momentum and feeds those targeted characteristics into the MPT optimization machine.
It allows you to systematically harvest specific risk premiums.
It does.
It sounds flawless. I mean, we have the Markowitz efficient frontier. We have factor-based smart beta targeting behavioral anomalies. We have a mathematically optimized machine that can quiet the noise of the market and maximize our returns.
This raises an important question. If the machine is so perfect, why do portfolios still fail?
Yeah, what?
Because when you look closely at the architecture of everything we just discussed, there is a structural vulnerability that threatens the entire system.
Okay, wait. Let's look back at step 1 of the MPT process, the very first thing you have to do to make the math work. You have to input the expected returns, the variance, and the correlation of all these assets. Where do those numbers actually come from?
They are completely derived from historical data. We look at how these assets behaved over the last 10, 20, or 50 years, and we plug those averages into the algorithm.
But historical data is just the past. To optimize a portfolio for tomorrow, aren't we just guessing? I mean, you are fundamentally guessing what the future returns and correlations will be. You're feeding guesses into a precise mathematical formula.
You are. The source calls this estimation risk, and it is the unavoidable truth of this entire discipline.
It seems like a fatal flaw.
Estimation risk is the inescapable reality of finance. The calculus of the efficient frontier is flawlessly precise, but the inputs driving the calculus are incredibly fragile.
Let's look at the sensitivity of the math here. How fragile are we talking? If I estimate a specific smart beta factor will return, say, 8% over the next decade, and it actually returns 7.5%, does the whole optimized portfolio shift?
Drastically.
Yeah.
The optimizer in MPT is completely blind to nuance. It aggressively seeks the absolute mathematical peak of efficiency.
Right.
If you tell the algorithm that asset A will return slightly more than asset B with slightly less variance, the algorithm won't just suggest a moderate tilt. It will heavily disproportionately overweight asset A.
It basically acts as an error maximizer.
That is the exact term industry quantitative analysts use. If your data is slightly skewed, maybe a certain asset class had an unusually quiet, high-return decade that will never repeat, the algorithm treats that historical anomaly as an ironclad law of physics.
Wow.
It will tell you to dump a massive portion of your net worth into that one asset class because the math says it is optimal.
So a tiny, tiny error in your guess about future returns completely radically alters the output weights. You might end up with a portfolio heavily concentrated in, I don't know, emerging markets, simply because your initial guess was off by a fraction of a percent.
Exactly. And it is even more dangerous with correlation estimates. If your covariance matrix assumes two assets will move in opposite directions, the algorithm will load up on both, assuming they cancel each other's risk out.
The acoustic phase cancellation we talked about.
Right. But in a true global market panic, correlations often go to 1. Everything drops at exactly the same time. If your estimated correlation is wrong, your perfectly safe, mathematically optimized portfolio becomes a synchronized freefall.
So what does this all mean? If the math is based on flawed guesses, why do we use it at all? Is it all just a mirage? We spend all this time dissecting standard deviation, efficient frontiers, and behavioral factor tilts, only to realize the steering wheel is disconnected from the axle because we simply cannot predict the future.
It does feel that way sometimes.
Why do institutional wealth managers even bother running these models if the estimation risk is so devastating? Should we just throw darts at a board?
Not at all. The true value of modern portfolio theory and smart beta is not in their predictive power because, as you said, they're terrible at predicting the future. They can't do it.
Okay, so what is the value?
Their true value is that they provide a rigorous, logical, structured framework to manage and think about uncertainty.
It forces discipline on a chaotic environment.
Precisely. It demands that you explicitly quantify your assumptions. It forces you to think deeply about how different assets interact under pressure rather than just chasing past performance. It gives you a roadmap.
Even if the map isn't perfect.
Right. Knowing the map is slightly inaccurate is much better than wandering into the wilderness with no map at all.
It prevents you from taking uncompensated risk. I mean, you aren't going to accidentally put your entire net worth into a single speculative tech stock if you are following the MPT framework, because the optimizer will immediately highlight the massive variance and the lack of diversification.
The goal isn't to eliminate uncertainty, because you never can. The goal is to build a structure robust enough to survive it.
That makes a lot of sense. So let's pull this all together for you, our listener. We started by redefining the raw engine of investing, moving away from the emotional fear of loss and recognizing risk purely as volatility, the necessary cost of higher returns.
Right.
We looked at the genius of diversification, how combining non-correlated assets creates that acoustic phase cancellation, lowering the overall noise of the portfolio.
We then explored the 3 steps of modern portfolio theory, mapping those combinations to find the efficient frontier, and how smart beta upgrades that broad framework by targeting the mechanical drivers of value and momentum.
And finally, we confronted the humbling reality of estimation risk. The realization that all this beautiful optimization is ultimately at the mercy of our inability to perfectly forecast tomorrow.
What's fascinating here is that taking control of your portfolio isn't about having a crystal ball. It's about knowing your own comfort level with the unknown. Successful investing ultimately requires a profound sense of humility. You are not trying to build a portfolio that perfectly predicts what the market will do next year. You are trying to build one that survives whatever the market decides to do.
Which completely shifts how you approach long-term planning. And honestly, I want to leave you with a final thought to mull over, because this framework extends far beyond finance. If all these brilliant financial models are essentially just highly structured ways to cope with a future we can't predict, how might we apply this idea of estimation risk to massive life decisions?
Oh, that's interesting.
Right, because we make huge life choices based on historical data of ourselves. Think about choosing a career path or deciding to move to a new city. You are estimating the return on that decision based on who you are today. But you suffer from massive estimation risk.
Your preferences will change.
Exactly. The industry you enter might collapse. Your assumptions about what will make you happy in 20 years are basically just educated guesses fed into a fragile mental model. We are always making long-term bets based on flawed guesses about our future selves. So the question is, how do you build an efficient frontier for your own life?
That's a huge question.
It is. How do you diversify your skills, your relationships, and your experiences so that when your long-term guess turns out to be wrong, you aren't completely wiped out? You don't need a crystal ball for your life. You just need to intelligently manage the variance. Thank you so much for joining us on this deep dive. Keep learning, keep questioning the inputs, and we'll see you next time.